दोस्तों नमस्कार। आज दिन 13 अक्टूबर 2025 को HCL टेक्नोलॉजीज लिमिटेड ने अपने Q2 FY26 के रिजल्ट्स अनाउंस किए हैं। इस वीडियो में हम कंपनी के फाइनेंशियल स्टेटमेंट्स स्टडी करते हैं, देन वी विल गो आफ्टर द टेक्निकल चार्ट पैटर्न ऑफ द स्टॉक एंड देन we will go through the earnings con call of the company. These are the financials of HCL Tech dated 13th October 2025 and consolidated figures अगर कंपनी की देखे जाएं, टोटल इनकम कंपनी की निकल के आई है 32,357 करोड़, जो कि प्रीवियस क्वार्टर में थी 30,805 करोड़ एंड इन सेम क्वार्टर इन लास्ट ईयर 29,318 करोड़। क्वार्टर ऑन क्वार्टर टोटल इनकम 5% इंक्रीमेंट दिखाती है, जबकि वाई ऑन वाई 10.4% की डबल डिजिट इंक्रीमेंट। इन द फ्रंट ऑफ एक्सपेंसेस, टोटल एक्सपेंसेस कंपनी के निकल के आए हैं 26,655 करोड़, जो कि प्रीवियस क्वार्टर में थे 25,616 करोड़ एंड फॉर सेम क्वार्टर इन लास्ट ईयर 23,631 करोड़। टोटल एक्सपेंसेस में भी 4.1% इंक्रीमेंट दिखाई देती है, जबकि वाई ऑन वाई सिग्निफिकेंट एक्सपेंसेस बढ़ते हुए नजर आए हैं, दैट इज अराउंड 12.8% इंक्रीमेंट। प्रॉफिट फॉर द क्वार्टर निकल के आया है 4,236 करोड़, जो कि पास्ट क्वार्टर में था 3,844 करोड़ एंड सेम क्वार्टर इन लास्ट ईयर 4,237 करोड़। कंपनी का पैट 10.2% इंक्रीमेंट दिखाता है क्वार्टर ऑन क्वार्टर बेसिस, जबकि ईयर ऑन ईयर दैट इज ऑलमोस्ट फ्लैट। ईपीएस की तरफ अगर हम चलें, ईपीएस स्टॉक का निकल के आया है 15 रुपए 63 पैसा, जो कि प्रीवियस क्वार्टर था 14 रुपए 18 पैसे एंड इन लास्ट ईयर फॉर सेम क्वार्टर 15 रुपए 62 पैसे। ईपीएस भी ऑलमोस्ट वाई ऑन वाई बेसिस टोटली फ्लैट नजर आता है। आइए अब चलते हैं स्टॉक के टेक्निकल चार्ट पैटर्न की तरफ। दिस इज द टेक्निकल चार्ट पैटर्न ऑफ स्टॉक ऑन वीकली बेसिस। यहाँ पे हमें स्टॉक एक डबल बॉटम लगाता हुआ दिखाई देता है, समथिंग नियर अराउंड द प्राइस ऑफ ₹1383। एन इंटरेस्टिंग थिंग इज दैट स्टॉक जून 2024 में जिन प्राइस लेवल्स पे ट्रेड करता था, राइट नाउ भी स्टॉक अभी उन्हीं प्राइस लेवल्स में ट्रेड करता हुआ नजर आता है। दिस इज द ट्रेडिंग व्यू प्लेटफॉर्म एंड यहाँ पे अगर हम निफ्टी 50 से कंपेयर करें, स्टॉक ने क्वाइट सिग्निफिकेंटली अंडर परफॉर्म किया है निफ्टी 50 रिटर्न्स को एंड राइट नाउ स्टॉक अपने जीरो लेवल्स के नियर बाई ट्रेड करता हुआ नजर आता है। दैट्स ऑल फॉर द ब्रीफिंग फ्रेंड्स। आइए अब हम चलते हैं कॉन कॉल की तरफ। थैंक यू।
Thank you, Darwin. Good morning and good evening, everyone. A very warm welcome to HCL Tech's Q2 FY26 earnings call. We have with us Mr. C. Vijay Kumar, CEO and Managing Director, HCL Tech, Mr. Shiv Walia, Chief Financial Officer, along with the broader leadership team to discuss the performance of the company during the quarter, followed by a Q&A. In the course of this call, certain statements that will be made are forward-looking, which involve a number of risks, uncertainties, assumptions, and other factors that could cause actual results to differ materially from those in such forward-looking statements. All forward-looking statements made herein are based upon information presently available to the management, and the company does not undertake to update any forward-looking statements that may be made in the course of this call. In this regard, please do review the safe harbor statements in the formal investor release documents and all the factors that can cause the difference. Over to you, CVK.
Thank you, Nitin. Good morning, good afternoon, and good evening, everyone. Thank you for joining our second quarter earnings call. I hope all of you are doing well. This was a strong and energizing quarter for us with broad-based growth, expansion in margins, and exceptional bookings. We are seeing the results of our strategy come to life, and I'm proud of how our teams are executing and winning in the market. Our revenue grew 2.4% sequentially and 4.6% on a year-on-year basis in constant currency. Our services business grew 2.5% sequentially and 5.5% year-on-year in constant currency, with robust growth in IT and business services and ER&D services. Our software business, subscription support and professional services revenue grew 9% year-on-year, while the overall revenue was lower due to lower perpetual license revenue. This reflects our objective to increase subscription revenue, which is expected to provide more sustainable value compared to the perpetual license revenue. Our operating margins came at 17.5%, an increase of 116 basis points sequentially. This aligns with the recovery plan shared last quarter. While there is more to do, I am pleased with the progress so far. This quarter saw strong, well-balanced bookings across service lines, geographies, and verticals, resulting in $2.6 billion of new booking. This is the first time we crossed the $2.5 billion mark without a contribution from any mega deal. We also signed 2 large deals this quarter, which we mentioned as delayed last quarter. We grew our employee base in line with the demand as we saw strong bookings and a good demand environment. More importantly, we continue to grow our revenue per employee as we leverage AI in everything we do. I'm proud and happy to share Time Magazine recognized us as the highest ranked India headquartered technology company for the second consecutive year in the World's Best Companies 2025. Little later, Shiv would unpack detailed financials across service lines, geographies, verticals, and the client segments. I will cover a little bit more on our AI propositions. This quarter, we reached a major milestone by generating over $100 million in advanced AI revenue through our diverse service lines and IPs. This is about 3% of our total revenue. The credit goes to our exceptional teams across the company and the leadership for achieving this impressive milestone. Our people are embracing the transformation from a people-based business towards a model that seamlessly blends AI IP with human-in-the-loop capabilities. Over the past few years, we've made significant investments in building intellectual property, deepening partnerships, and strengthening our GTM and delivery teams. These efforts are now yielding results as we transition from the AI pilot stage to the AI monetization phase. As we called out in our investor release, advanced AI includes rapidly evolving AI technologies like agentic AI, physical AI, AI engineering, AI factory, etc. To clarify further, this excludes classical AI, data and analytics services, and the services delivered using Gen AI and agentic AI. This achievement is a clear outcome of our strategy. As we have shared before, our strategy is clear and focused on shaping the future of our business and the industries we serve. There are 4 key elements to this strategy. First, we are proactively transforming our services with a long-term view and the confidence to evolve, even if it means disrupting parts of our existing revenue base. This mindset keeps us agile, relevant, and future-ready. The second part of our strategy, we are investing in building differentiated IP that accelerates and scales AI adoption for our clients. While companies like OpenAI, tech OEMs, hyperscalers continue to advance the core intelligence layer and the computing needed for this, our opportunity lies in making that intelligence enterprise-ready and impactful at scale. We are developing IPs that power transformation across IT, SDLC services, engineering services, BPO services, as well as industry-specific use cases built on top of that intelligence layer. The third element of our strategy, we are expanding into new AI-led services, including AI engineering, which has a lot of silicon for inferencing chips, AI factory, AI advisory, and these services leverage our strong foundation in engineering, infrastructure, and the deep industry expertise. The fourth element, we are strengthening and expanding our AI partnerships across the entire technology stack, from GPU providers to model and agentic platform providers. These partnerships are instrumental in helping us deliver impactful end-to-end AI solutions that drive real business outcomes for our clients. Transformation of our talent and onboarding new talent to enhance our capabilities is central to our strategy. We are fully committed to this strategy. The momentum is building, the results are encouraging, and our conviction is stronger than ever. We believe this approach positions us to lead in the AI era and define the next phase of growth for our company and our clients. I would like to share our AI progress last quarter across 3 key dimensions. One is offering, second is engagement, and the third is partnerships. On offerings, our AI Force platform, we launched V2.0 beta release with GA planned in January 2026. This version marks a significant leap forward, bringing agentic workflows, orchestration, and responsible AI together into one unified platform across IT, software, and business operational services. Our AI Force platform is now deployed across 47 accounts, up from 35 last quarter, and is the key solution enabler for most of our wins. I would also like to bring the overall goal of 100 clients, 100 of our top clients, to be leveraging the AI Force platform is the goal that we are working towards. We continue to invest and build repeatable AI solution for industries. The Insight Gen in financial services and VisionX in manufacturing are 2 that are seeing good traction. Under advanced AI, we have added 2 new offering pillars of AI Factory and AI Advisory. The AI Factory proposition we are taking to market in very close partnership with partners like NVIDIA, Dell, and HPE. We are engaged with one of the global top 10 tech companies in implementing global AI factories. We see strong demand here and we are scaling our teams to service this demand. In AI Advisory, we will be helping our clients deploy AI at scale by advising at strategic points in their adoption journey, from use case prioritization to business case formulation to POC and deployment blueprints, followed by organizational level change management and responsible AI. We also launched a new AI security and red teaming offering. In physical AI, we signed a deal in robotics with AI, which is a proposition that is catching great interest in tech and heavy industries. In data and AI Foundry, we launched new capabilities and accelerators to enable business persona-driven agentic AI solutions for data modernization and analytics. On engagement maturity dimension, we are witnessing the size of our engagements becoming bigger every quarter. Most of our services deals are now embedded with advanced AI capabilities as they come up for renewal. 5 of our top 10 renewals came with increased ACV, while the specific SOWs in the remaining ones had a decline due to AI-linked productivity. These are from large growing clients, and we do see opportunities to consolidate more work due to our proactive strategy in scaling AI with these clients. Some key examples from Q2 reflect the maturity in our AI engagement. We signed a major legacy modernization program with a leading European retailer to upgrade their order management system. Using AI Force, we are automating design, build, and test workflows, resulting in 30 to 40% increased developer productivity, shorter cycle times, and greater agility in software development. A Fortune 100 aerospace company chose HCL Tech to create contour scanning software and a simulation testbed. Using physical AI and automation, HCL Tech will support precision manufacturing, faster validation, and improved production efficiency. A US global manufacturer selected HCL Tech AI Advisory Services to build an enterprise AI and governance framework to scale AI initiatives with measurable ROI, regulatory compliance, and responsible AI principles. A large US telecom company selected HCL Tech to launch an NVIDIA-powered emerging tech AI lab. Here we are setting up a high-performance AI cluster and deploying state-of-the-art models such as Llama 405B, Maverick, and Scout. Apart from this, we have several clients who are leveraging our advanced AI services. We think there is great potential to partner with these clients to grow our advanced AI business further. On the third axis is the maturity of our enabling ecosystems consisting of our people and partners. We see good demand for OpenAI enterprise adoption, and we are training more people to support this journey. We announced 2 more significant collaborations this quarter. We announced a multi-year strategic partnership with Pearson to co-develop AI-powered products and services designed to close skill gaps, empower individuals to advance their careers, and help organizations succeed amidst the rapid technological change. We joined MIT Media Lab in the US to collaborate in shaping the future of AI and emerging technology areas such as quantum computing. While we sign these new collaborations, we continue to excel in our existing AI ecosystem. We received the Dell AI Partner of the Year Award for Vision X Solution. HCL Tech is the only SI partner to receive this award. We announced new partnerships with SailPoint on AI-driven identity transformation and with Thought Machine to accelerate AI and cloud-led transformation of banks. On the people side, we continue to train our people at scale. We are building black belt cohorts on every technology stream. We trained 820 black belts in H1 alone, while our data and AI principal cohorts are now strongly embedded in more than 50% of our priority accounts. We've also undertaken an AI skill standardization framework and have identified 14 top AI skills for scaling our AI talent base. As a testimonial to this maturing momentum, we received multiple leadership citations for our AI business this quarter that are mentioned in our investor release. The progress we've made on advanced AI over the last few quarters gives us great confidence in our AI propositions as it resonates with our clients. Every investment we've made till date builds the conviction that it was very well invested. As we further accelerate our journey to address the expanding market to help enterprise clients realize value out of their AI investment, we expect to further invest in advanced AI propositions, IPs, go-to-market capabilities, and partnerships. I will dwell a little more regarding our bookings. We crossed $2.5 billion of new bookings without mega deals. We continue to invest in a strong global sales engine that meets diverse client needs. For instance, our public sector GTM group secured a large aerospace and defense contract with a new client last quarter. As you would all know, new bookings we disclose do not include rate card deals or renewals. We emphasize more on the new booking metric, which generally has a strong correlation with revenue growth, typically observed with a 1 to 2 quarter lag. Nearly all deals include AI, and a comprehensive suite of AI offerings was instrumental in securing multiple large strategic wins. You would find the details about our key wins in our investor release. As you would have noticed, we have been growing strong in 3 large verticals, which is BFSI, technology, and telecom and media. We see a similar trend emerging in retail CPG that should help us grow in the future as well as diversify our portfolio. We continue to win and grow in our retail and CPG business as clients show intense interest in a prudent approach to adopting and scaling AI. A couple of areas where we see this include integration work in M&A or carve-out related separation work, and in large-scale SDLC transformation work supported by generative AI, especially our AI Force platform. We are seeing similar trends in life sciences and healthcare as well as in our public services. While the broader manufacturing segment is doing fine, there is continued impact due to the auto sector slowdown within the overall manufacturing vertical. Next, I want to share some thoughts on our software business. As a business, this is growing from strength to strength. For example, HCL Software has been named a leader in 2025 Gartner Magic Quadrant for Application Security Testing. This is significant as we advanced from challenger position in 2023 to leader position in 2025. We received the second highest score on completeness of vision among 16 evaluated vendors, a strong validation of our forward-thinking approach to application security and our alignment with the market needs and buyer expectations. HCL Software has been named a leader in 2025 Gartner Magic Quadrant for Service Orchestration and Application Platform, acronymed as SOAP, which makes it twice in a row for us. This consistent recognition from Gartner is all thanks to HCL Uno, especially the recent HCL Uno agentic delivery platform, which was called out for its end-to-end orchestration capability. This is a missing piece in the entire agentic AI and software services as a software proposition, so Uno is a very strategic component in that. This feature enabled us to be the second highest rated in completeness of vision among the 12 vendors evaluated this year. Coming to the pipeline and market trends, our pipeline remains robust and has grown to a record high, well supported by our advanced AI propositions. It's well distributed across business segments, verticals, and geographies, with AI, Gen AI, agentic now central to nearly every deal, serving as a productivity enhancer as well as an innovation toolkit. While the external environment continues to be unpredictable, our key business indicators like revenue growth, booking, pipeline, AI demand, etc. all look promising. While there are some concerns about the long-term trajectory of the industry, we feel there is and will be a huge tech services market. This AI wave would create big winners, and those winners would benefit big over the long term, as clients always need a partner who can bring various technology capabilities together to build and operate solutions that solve business problems. To be a winner, one needs to have the scale and reach to develop AI IP-led propositions, have a great ecosystem of partners, and most importantly, have a strong engineering and a software culture, which we pride ourselves. We strongly believe this core competence of technology services partners is what global enterprises will always seek to realize value beyond buying technology tools and platform. At HCL Tech, we are focused, or rather obsessed, to be such a partner to enterprise clients. Coming to the last topic, which is on immigration, I know a lot of you may have questions regarding H-1B visa fee revision and its potential impact on us. Over the years, we've made conscious effort to reduce our reliance on visas by strategically strengthening our global delivery model. Our dependence on visa is now down to a few hundred visas a year. In Q1 this year, Forbes recognized us as one of America's best employers for new grads 2025, underscoring the success of our approach towards fostering innovation, career growth for early professionals, and talent readiness. Overall, we intend to increase our local hiring and training to enhance our localization. With that, I would request Shiv to walk you through more details on the numbers. Over to you, Shiv.
Thank you, CVK. Good morning, good afternoon, and good evening to all of you. Thank you for joining our Q2 Financial Year 26 earnings call. Let me walk you through our financial performance for the quarter. Starting with the revenue performance, total revenue for the quarter is $3,644 million, a growth of 2.4% quarter-on-quarter and 4.6% year-on-year in constant currency terms. Services revenue for the quarter came in at $3,322 million, a growth of 2.5% quarter-on-quarter and 5.5% year-on-year in constant currency terms. For ITBS, services grew 2.6% quarter-on-quarter and 3.8% year-on-year. The ERS segment grew 2.2% quarter-on-quarter and 13.4% year-on-year in constant currency terms. Our recent CTG asset acquisition from HPE has been delivering financial results in line with our business plans. It has also given us the opportunity to address the needs of a much larger global telecom client base with a richer value proposition. Software revenue for the quarter is $333 million, a growth of 0.5% quarter-on-quarter and decline of 3.7% year-on-year in constant currency terms. Within the software segment, subscription and support and professional services revenue grew at 8% year-on-year in constant currency terms. This performance reflects our priority to grow subscription and support and professional services revenue lines. In terms of geographies, during the quarter, USA, the largest IT services market, grew at 2.4% year-on-year. Europe grew at 7.6% year-on-year, while India grew at 0.6% year-on-year, and rest of the world reported an increase of 17.9% year-on-year. Regarding verticals, we saw broad-based Q-on-Q growth across key verticals, with some achieving double-digit year-on-year growth despite the macro environment. Our top performing verticals on a sequential basis were life sciences and healthcare and public services, whereas on a year-on-year basis, financial services and technology fared well. They grew at 11.4% and 13.9% respectively. In terms of clients, we remain focused on adding and expanding G2000, Ecorent, and emerging enterprises. This quarter, we made good addition to our client portfolio across verticals and geographies. On a year-on-year basis, we added 2 clients in the $50 million category, 14 in the $20 million category, and 7 in the $10 million category. HCL Software is steadily broadening its client base across multiple industries and geographic regions, with this portfolio exhibiting strong performance and facilitating the acquisition of new clients. This impressive execution positions us well for the future growth. Now, let me share the details on profitability. Our EBIT is $637 million at 17.5% of revenue. Net income for the quarter is $486 million at 13.3% of revenue. The margin bridge explaining the same is as follows. The company margins have increased 160 basis points quarter-on-quarter. The improved profitability for the software segment gave us 35 basis point benefit. For services, the 81 BPS quarter-on-quarter increase was driven by following factors. Absence of one-off that hurt margins in Q1 gave us positive 30 basis point in this quarter. Project Ascend helped us to obtain 50 basis point gain from higher utilization during the quarter. Forex gain from INR depreciation gave us positive 56 basis point, and restructuring expenses had an impact of negative 55 basis point. As we had indicated in July, our annual guidance, quarterly numbers, and commentary, all of them include the impact of one-time restructuring hit in financial year 26. For clear comparisons, we would encourage you to keep this in mind. Now, moving on to return on invested capital, ROIC. Our ROIC continues to improve thanks to our ongoing focus on profitability and efficient capital management. The last 12 months ROIC is at 38.6% for the company, which is up 290 basis points year-on-year. And for services, ROIC now is at 45.3%, up 180 basis points year-on-year. Software continued to improve with ROIC at 21.8%, up 396 basis points year-on-year. Let me share the details on our strong cash generation now. Over the last 12 months, operating cash flow is at $2.62 billion, while free cash flow amounted to $2.48 billion. Operating cash flow to net income conversion is at 133%, and free cash flow to net income is at 125%. The balance sheet continues to strengthen with gross cash at $3.56 billion and net cash at $3.29 billion. This cash generation is on the back of our continued improved DSO performance. Our total DSO, including unbilled, is currently at 78 days, an improvement of 4 days quarter-on-quarter and 1 day year-on-year basis. For our shareholders, the diluted EPS for the last 12 months came in at rupees 62.57, which is up 0.9% year-on-year. The board has declared an interim dividend of rupees 12 per share for the quarter. The record date is 17th of October 25. Payment date of the same shall be 28th of October 25. That brings our 12 months payout to rupees 60 per share, effectively distributing 95.7% of our net income. Now, the guidance. On the back of standout quarter and sustained growth momentum, we are raising our full year services revenue growth guidance to 4 to 5% in constant currency terms. Given the softness in software segment due to decline in perpetual licenses revenue, we are keeping the company level guidance unchanged at 3% to 5% in constant currency terms. We remain on track to deliver our full year EBIT margin guidance of 17% to 18%. The wage revision cycle, which will kick in Q3, the revision is expected to be similar as last year. Q3 is expected to have 70 to 80 basis point impact, and Q4 to have an incremental impact of 40 to 50 basis points. The impact is baked into our margin guidance. That's all from my side for now, and I would like to hand over the session to our moderator for Q&A session. Thank you. Over to you, Darwin.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. Our first question comes from the line of Abhishek Pathak from Motilal Oswal. Please go ahead.
Hi, am I audible?
You are audible, sir. You may proceed.
Hi, team. Thank you for the opportunity and congrats on a solid quarter. CVK, very encouraging to see advanced AI revenue broken out. Quite curious to know how are these revenues being offered to clients? Are they mostly through standalone POCs or standalone projects, or are they kind of embedded into our bread and butter business? That's one. And secondly, how do you see HCL's revenue mix evolve over the next 3 to 4 years? I mean, do we expect IPs to contribute more and more percentage of our revenues? And if that's the case, how do you see our R&D expenses go up, considering we'll be competing head on with a lot of the rich world OEMs in their own backyard? And lastly, a question on margins for Shiv. On the restructuring charges, would we expect a similar sort of quantum of hit over the next couple of quarters as well? That's all from my side. Thank you.
Yeah, thank you, Abhishek, for a lot of interesting questions. And first is advanced AI. It's got a number of different ways of billing. For example, a lot of inference silicon build work are more fixed price projects which we take with clients and deliver. And that has got a lot of scaling, and there are a lot of reusable components in that. That's number one. And for example, for the AI factory, the implementation could be even time and material, but there is a run piece which is based on per rack and things like that. Then there are a lot of custom AI solutions that we are building for our clients, which is continuing to be contracted in the traditional ways. Some of them, most of them in some kind of a fixed price model, because we also leverage some solution accelerator there. But there could be number of time and material also. And on top of it, there is an IP element. Like, for example, AI Force is being used in the SDLC transformation. The AI Force has got a licensing price list, and that's what we are considering as an advanced AI revenue. All the services that are being delivered, that is not considered in this category. And there are a couple of small products in HCL software. They also are being sold as IPs. So right now the IP component is small. Now going into your next question on what do we expect our IP trajectory to evolve. We believe this industry will have to evolve from being a pure labor-based service provider to people plus IP and platform-based service provider. And when you have the platform as a third-party platform, I think there is very little leverage, very little stickiness that we can build. And we believe we can really deliver very good quality vertical IP solutions which can be replicated across customers. So that is why we are investing. However, the investment that is required to create that intelligence layer, that's not something we are taking on ourselves. We are really leveraging the intelligence layer created by OpenAI and Llama and all the tech companies. We are really creating IPs which make this intelligent layer a lot more usable, scaling and relevant for the enterprise. I think this is the sweet spot where we are focused on, and everything goes through a rigorous kind of exercise. And we are open to invest, and we really don't have a full picture on how much investment this will need. But I think this is really required for the long-term, vibrancy of the business. And I think it's a very good investment to make. We have already identified a few products. AI Force is what I would strongly call as a killer app, which is really making a lot of big deals happen. And we are competing head-on with all the big players who have a lot of AI, whatever mindset. We've been able to kind of showcase because of the technical depth of the product, especially when the client evaluates getting their hands dirty, we come out winners. So I think it's a strong proposition. It's a big strategic initiative for us. We will not hesitate to make the right investments to make this a big success. I don't have a revenue number as to what our IP will be, but for sure it is going to consistently increase in our services portfolio.
That's very helpful.
Anything else, Angus?
Yeah, so regarding restructuring, Abhishek, in July we announced around 40 basis point impact of restructuring for the full year. We expect this to be only slightly on the higher side for the full year based on whatever visibility we have right now. We, as you would have noticed, we started this exercise in Q2, and this will continue through Q3, and we expect to have some spillover in Q4 as well. So,
got it. Thank you. Perfect. Thank you. And
the list of IPs are already called out in our investor release for your reference.
Thank you. Ladies and gentlemen, we request you to please restrict yourselves to one question and one follow-up question. If you have further questions, you may rejoin the queue. Our next question comes from the line of Ravi Menon from Macquarie. Please go ahead.
Hi, thank you. Congrats on pretty broad-based growth. So the first question is on the EBIT margin. So if I adjust for that 55 basis points of restructuring, you're almost back at your 18 to 19% range, and you should surely get some cost benefit from restructuring going into next year, right? That's a question on hand, which is how much will the benefit be, once you finish the restructuring? So on a structural basis, how much margin improvement should we factor in because of the restructuring?
That's as you said, we have given the guidance for this year 17 to 18%, and then we talked about at the time of lowering the guidance last quarter. We did talk about one-off which are hurting us, and we also clarified that we are not structurally lowering our margin band, but in terms of what it is going to be next year, we would like to address that question when we give our next year's guidance in April. Ravi.
That is fair, but just trying to understand what's the benefit that you're expecting to get. Is it 20 bips, 30 bips? What should it be?
So difficult to call out. As I said, some of the one-off we talked about, I think we have recouped some of the benefit, but restructuring, I guess, whatever, I think we should get, the process is still on. As I said, we have just started this exercise in this quarter. It's going to continue for next quarter, and maybe it is going to spill over for the Q4 also. So difficult to exactly pinpoint the kind of the benefit we are going to get.
Right.
We will definitely transparently call this out during the Q4 numbers because there are a lot of moving parts. So we'll definitely provide the transparency around that.
Thank you. I understand that only part of it is employees and part of it is rentals and things like that. Right. Okay. The other question is more structurally. A lot of people have been worried about the impact of AI on the existing book of business. If I understood correctly, the most impact is happening in the area of development, where Gen AI pays a really significant improvement in productivity of coding. But in the more, I'd say the IT outsourcing side of things, whether it's infrastructure or application maintenance, do we see a significant pressure on the existing book of business?
Yeah, I think as I called out even in the investor day, We think the biggest impact is on the BPO business, which could be as much as 40 to 50%. SDLC, 25 to 30% is what we think is doable with a lot of maturity. In IT ops, application support and maintenance, it will be 10 to 15%, but it also depends on where you are in the automation journey. In the infrastructure and application operations, a lot of work can be automated by the traditional machine learning and AI and the rule-based automation. But if you have fully leveraged the existing machine learning and rule-based automation, then incremental impact can be 10 or 15% kind of thing. So I think this is the direction, and obviously you know the mix of our business, and some of this will play out over a longer period of time, like software development. Even if we are able to deliver 25 to 30%, but to scale for the entire 1,000 or 2,000 people large setups, it does take significant amount of time. It could run into a couple of years. So I think this productivity will be realized over a period of time, but certainly there is a good headroom in improving either velocity or productivity, whichever way you want to look at it.
Thank you again. Are you seeing, where you have passed this on, is there enough elasticity in the demand to more than offset it?
I think the biggest demand elasticity is in the modernization. We are, while discretionary spend is whatever it is, we are seeing a number of programs which are coming up based on legacy modernization. Like we did call out a very large legacy modernization program for Ericsson in our investor release, and a very large European retailer as well. These programs, they probably were not even looking at it a year ago. With a lot of conviction and proof point on what can be done, they are much more open, and now these are close to $100 million plus programs, which is quite big from a discretionary spend perspective. So I think that is where the demand could really be might kind of open up as we see more and more success in this.
Thanks so much again. One last clarification. I know that you don't include renewals in your TCV, but even with a scope expansion, do you even include the expansion of scope, like say the renewal with Volvo? Would any scope expansion be factored into the TCV?
Yes, any new revenue coming in scope expansion gets added into booking numbers.
Thanks so much. Best of luck.
Thank you. The next question comes from the line of Sudhir Guntupalli from Kotak Mahindra Asset Management. Please go ahead.
Hey, hi CVK and team. Congrats on a good quarter. As the largest IMS player globally, how do you see the need for enterprise data center refresh as we go through the AI upgrade cycle? And what would our play be in this value chain? Will we continue to focus only on the managed services piece, or are we willing to now offer services on co-location and cloud service provider modes as well?
We strongly believe in an asset-light business model, and I think there is enough opportunities in the current world to really do a very, very good asset-light business scale-up. So if you see, our direction is actually going slightly in the reverse. We are going to build more IPs and monetize IPs. Of course, this AI factory is all about servicing large mega giga data centers that are being set up by large tech players. I think that itself is a huge services opportunity, and it is really getting very, very specialized. And fortunately, we have one big program which we are managing for one of the large tech companies, and that itself can expand. And there are at least 20 such players and sovereigns and some enterprises who are building this. So that can be a big, big opportunity without having to invest in big assets and data centers and real estate and all that.
Sure, sir. And just to follow up, so if you look at the IMS cycles, they're pretty, they have their own rhythm, a little bit different from the app development and modernization. So do you see the next upcycle in the IMS space beginning anytime soon, partly led by this CPU to GPU upgrade of the existing data centers?
Yeah, we have seen some traction. I don't think it's picking up. From an enterprise side, it's still not picked up in a big way. But there are some edge use cases where we see edge compute with GPUs and all that is becoming relevant. I would think it's early days to really look for a large cycle of enterprise upgrade of CPUs to GPUs.
Sure, sir. Thanks, and all the very best for the future.
Thank you, Sudhir.
Thank you. We have our next question from the line of Abhishek Kumar from JM Financial Limited. Please go ahead.
Yeah, hi. Good evening, and good insight on our AI strategy and progress. I have one question on bookings. CVK, you mentioned that we are proactively cannibalizing the existing business, and also in some of the SOWs that we have got renewal, the existing SOWs has seems which we have been able to offset through new scope, etc. Now, in that context, I just want to understand how relevant is the net new number, right? Because it is coming at the expense of renewals. So maybe some color on how has the overall deal bookings growth has been, and if we can going ahead provide full TC, but that would give us the full picture of renewal plus net new. That's the only question for myself.
Actually, we obviously track renewals very, very closely internally, but we are not ready with the numbers to share. And but from a growth perspective, it's really the net new booking which really matters. And obviously, there is some dependence on some ramp downs and things like that, which I think has been quite stable. We don't see anything unusual now. So I think our net new booking will be a very good correlation for growth. Now, this renewal deflation, I did call out last quarter. In 8 of the 9 deals, we got additional business. This time, we did call out among the top 10, only 5 of them gave us additional business. Other 5 of them had specific SOWs which saw some deflation. But what is comforting is these are large clients of us. One segment of the work, there is some deflation. And there is a lot of book of business that we can consolidate with these large clients based on the proof points of proactively delivering AI-led productivity. I think that's a very good indicator for you to see how things are playing out.
Sure. Maybe just quick follow-up on this. So our, net new has been around $2 billion for a couple of years. Now, compared to, past where probably the deflation was not as much in renewal, should we look at slightly higher net new run rate to assume similar growth as we have seen in the past?
Yeah, we obviously, we had mentioned that we want to up our run rate from 2 billion to in and around 2.5 billion. And that's something which we've been working with a lot of rigor and a lot of science behind it. And we think we will get there soon. This quarter obviously was a 2.6 billion without a mega deal. And I do think our pipeline is good. Our win ratios are good. And we're well set up for a 2.5 billion kind of run rate. Of course, this can always be spikes sometimes, but on a run rate basis, I think we feel good about achieving this.
Sure. Thank you and all the best.
Thank you.
Thank you. Our next question is from the line of Vibhor Singhal from Nuvama Equities. Please go ahead.
Yeah, hi. Thanks for taking my question and congrats on a solid performance. CVK, just a couple of questions from my side. Just wanted to pick your brains on the auto vertical. I think the manufacturing vertical seems to have kind of lifted a bit from the last quarter, but where exactly do we see that? Do you still see weakness in the auto segment, especially in European markets? And what's our outlook for that segment, let's say, in the next 2-3 quarters? Do you think the weakness will persist? Or is there some signs of turnaround happening there? I'll just follow back to the next question. If you can answer this, please.
Yeah, auto vertical pipeline continues to look very, very strong, but decision making is just not happening. It's taking its own time. And some of the opportunities are kind of replacing incumbents and things like that. So they're all taking a long time. But given the stress in the industry, it's only a matter of time when we see some large outsourcing possibilities. But we have to wait it out.
Got it. But so nothing on the corner, at least at this point of time, as we see it.
Yeah, I would agree with you.
Sure. Just the last question, CVK, on the headcount number. Given, we were the first one who started calling out AI revenues. How do you see the overall headcount evolve, let's say for the company or for the industry over the next, not just quarter, but over the next 2 to 3 years with the event of AI? Do you think we'll be able to do more with less? Do you think the headcount number where we are today would actually be the same number we might be looking at maybe 2 or 3 years down the line with very limited net new additions from the competitors? If you can give some color on that, that'd be really great.
Yeah, I think it's directly a factor of growth. If you see our revenue in the last couple of years, we've grown 4-5% and our headcount has not grown. So I think that gives you a sense there is some non-linearity playing out. Even this quarter, our whatever revenue growth and people count, there is at least 1.5% or 1% at least there is a difference. And when you take a year-on-year, there is a 1.8% increase in revenue per employee. So I think that is the kind of uptick that we expect to see. It should gradually improve as we create more platforms, more IP, more solution and services as a software kind of propositions with agentic and all of that. We believe there is certain non-linearity. Even if you're able to achieve a 1% differential every quarter, I think it will start adding up to a meaningful non-linear pattern.
Got it. Thank you so much for taking my question, and I wish you all the best.
Thank you.
Thank you. Our next question comes from the line of Surendra from Citi. Please go ahead.
Yeah, hi. Good evening, CVK. Good evening, Shiv. Good quarter. And thanks for all the details that you shared. Just had a couple of questions. Firstly, this was asked earlier, but you said that out of top 10 renewals, 5 had increased the scope, increased ACV. So possible to give a sense of what the aggregate trend for those 10 deals would have looked like? What kind of growth in ACV would it have translated for all of those 10 deals put together?
So then we don't have the numbers ready and we didn't intend to share. This was only to give a directional view of our proactive approach of pursuing the clients to implement AI in a very meaningful way. I think we wanted to give, we are also tracking to get some comfort if our hypothesis of proactively driving this will drive more mindshare and more wallet share. At this point, we feel confident, but I think the difference is not every service provider is being proactive. A lot of providers are defensive as well, and that itself is an opportunity for us.
Fair enough, CVK. And is it reasonable to say that in the 5 instances where you gain shares, it would have come from peers in the industry?
Yes, and maybe some things might have been in-house as well.
Understood. And just a second question on the...
In financial services, at least it is a meaningful gain share in financial services. Meaningful gain share is something which I can confidently share.
Yeah, thanks
which
for
is
that.
Reflected in our 11% growth.
Understood. And last question on H1B, as you and your competitors all try to localize, and I understand that you are more localized than your peer group, but everybody tries to localize. Do you expect this to be some kind of a margin headwind for as we go into next year?
Yeah, it's definitely something to watch out for because obviously this trend will mean some higher investments in training, local hiring, and all of that. From a wage perspective, we have more or less, there's very little difference. But availability and all of that, we'll have to see how we'll manage it. Fortunately, the dependence is very low, so that way we feel comfortable.
But is there a risk of higher attrition?
Sorry to interrupt, Surendra. We request you to please rejoin the queue if you have further questions. Thank you. Our next question comes from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity. CVK, in one of the replies of the AI impact on the different horizontals, you called out it will take another 2 to 3 years because there are new things which need to be done before AI can be scaled up by enterprises like modernization and other stuff. So in that scenario, is it fair to assume that in the next 2-3 years, AI can additive in terms of demand rather than deflative? And the second question is on EBIT margin. This year, we have a lot of one-offs. So why we are still not saying that the next year we can be back to 18-19% EBIT margin? What holds you back to commit that? Because we are doing better in terms of margin even in this quarter, including one-offs.
So, Sandeep, I think you were a little confused on this modernization thing. Modernization is an independent stream. What I mentioned about scaling in the existing SDLC landscape is really to get a small group of people fully use, leverage, train them and measure productivity, ensure that we are getting the productivity and the entire change management for a large software development organization. I think that's what I'm saying it is going to take a couple of years. And modernization continues to be a separate motion. A lot of customers are looking at modernization. I think that is definitely an additive in terms of overall revenue for the industry. Now, with all puts and takes, where will it land depends on what the portfolio that one has. And you have a sense of our portfolio, so that's broadly where it is.
Thank you.
Yeah,
Ladies and gentlemen,
just to add, we are on track to recoup the margins we have envisaged, in last quarter, like one-off reversals and improved utilization. However, our clear focus is to cement our position as industry growth leader during this tectonic, shift in the industry. And to that end, we will prioritize investment in AI to help us grow the disciplined margins. So that's our focus is. And as I said, we are not going to call out the margin next year. We'll call out the margins when we do our financial year 27 guidance in April.
thank you. Ladies and gentlemen, we will take that as our last question for today. I would now like to hand the conference over to Mr. C. Vijayakumar, CEO and MD, for closing comments. Over to you, sir.
Yeah. In closing, we are energized by our performance in the quarter gone by, and we are confident of our trajectory for rest of the year. Thank you for your continued support. Wishing you and your families a very happy Diwali and joyous festive season ahead. Good evening and take care. Thank you.
That's all for the video friends. Please like and subscribe my channel. कोई भी इन्वेस्टमेंट डिसीजन लेने से पहले अपने फाइनेंशियल एडवाइजर की सलाह आप जरूर लें.